We're on to our second lesson in double entry. We have two accounting equations there we're going to record together. The first one says, on the 1st of January, started the business with $200,000 in the bank. Remember that every transaction affects at least two accounts. Alright, in this scenario, started the business, once you see the term started the business or introduced someone into the business, then the account that is affected by that statement is capital. But this owner started the business with $200,000 in the bank. Oh, it should be there. With $200,000 in the bank. No, which means he's opening a bank account for the business and he's investing some money in his business. So whether it's investing, started the business with, introduced some money into, then the account that is affected by that statement alone is a capital account. And the other account that is affected by this transaction is the bank account, because that's where he invested the money. That's where he put the money. So this is how we record that transaction. So the capital account and the bank account. Remember, we need to determine what category these two accounts fall into in order to know where to make the entry, if it's a debit entry or a credit entry. Now, capital account is capital, and capital has a double entry rule for itself, but the bank account is an asset, and assets have double entry rules for themselves. So here we go. The double entry rule for capital says to increase, we credit. So then you need to figure out, is this transaction increasing capital? Yes, it is increasing capital, because before this transaction there wasn't even a business, so there was no money introduced into the business yet. So to increase capital, we credit. That's the double entry rule, and capital is increasing by this transaction here. So to increase capital, we credit. So we credit the capital account. So we say January 1. Don't have to put the year if you don't want to. 200,000. And what's happening to the amount of money we have in the bank account as a result of this transaction? We started the business by putting money into the bank. Then the amount of money we have in the bank is increasing. Bank is an asset. To increase an asset, you debit. So we say January 1, 200,000. And what we put in this area is the other account affected by the same transaction and the other. So on the capital we'll have bank, and on the bank we'll have capital. Then we move on now to recording the other transaction. The other transaction says bought equipment by check, 15,000. Now the two accounts that are affected by this transaction are equipment and bank again, because once it's a check, it is also bank. We already have a bank account right there, so we don't need to draw up another. But we do not have the equipment account as yet. So we draw it up. The two accounts that are affected by transaction number 2 on January 2nd are the equipment account and the bank account. We already identified or established that the bank account is an asset. But what is the equipment account? That is also an asset. So when we buy equipment, we are increasing the amount of equipment we have in the company, so we shall agree that equipment is increasing. Equipment is an asset. To increase an asset, you debit. So you write it on the debit side. January 2. The bank account is the other account affected by the same transaction, $15,000. And then in the bank account, bank is an asset. When we buy equipment by check, the amount of money we have in the bank will fall because we're spending it to buy equipment. So the amount of money in the bank is decreasing. So since this transaction is decreasing the amount of money we have in the bank, and bank is an asset, to decrease an asset, we credit. So we credit the bank account. So we say January 2. What did we buy using our bank money? Equipment. $15,000. And that is pretty much it. Toodles to the next lesson 3.